In this short video, I'm going to discuss the current inflation levels and how that affects the property market. Hi, my name is Mark Lloyd. I'm co-founder of Property Master Academy, and I've been investing in property since 2005. Now, you don't need me to tell you that inflation seems to be running riot at the moment. And in this video, I'm going to talk about what inflation might mean for the property market. I'm also going to talk about how property can actually be a very good thing to be in during a period of high inflation. So first, what exactly is inflation? Well, you probably know that inflation means the rate of rise in the cost of living over a given period of time. So a 10% inflation rate means that something which you cost, say, £100 last year will cost you £110 this year. That's fairly simple. But this is very important to know about inflation. Inflation can be quite a misleading concept. When you hear the latest inflation rate, perhaps on the news, you're being told the average rate of inflation. Now, by definition, that means some things have increased in price by less than the average and other things more. Also, the main measure of inflation used in the UK, the CPI, or Consumer Price Index inflation, doesn't include house prices. So when thinking about the housing market, it's important to remember that inflation rises and house price rises are two completely different things. Cost of living inflation in the UK has only been around 2% or so each year for over 30 years. It's only very recently that it's started to soar. Currently, the rate of inflation in the UK is around about 9 to 10%, according to the Bank of England. However, house price inflation has been leaping ahead for a couple of years now. According to the latest Office of National Statistics figures, UK house prices rose 12.4% over the year to April. So what might high inflation mean for the property market? Well, the economy is being hit by a double whammy of inflation at the moment. High property price inflation and high cost of living inflation. Now, there are a few implications for the property market which you need to consider. First and foremost, people have less disposable income. And that is likely to filter through to the housing market. People are less likely to think about buying a new home in the first place. High inflation affects what is called buyer sentiment. It tends to create a kind of feel bad factor that encourages people not to take on big commitments. If they have to move, people are likely to make lower offers to avoid overstretching themselves, or perhaps favour cheaper property in cheaper areas. Tenants are likely to favour cheaper rentals too, and it can push some people into financial difficulties. Some people might be forced to sell up because they can't afford their home anymore, or even face repossession. In theory, all these factors should work together to push house prices down. That said, so far, house prices seem to be defying the laws of economics as they are still rising. Another big implication of high inflation is that interest rates are more likely to rise. Now, the interest rate, or bank rate, is the main tool the Bank of England uses to control inflation. The bank has a long-standing target set by the government to keep inflation down to about just 2%. Now, something which they are absolutely miles off hitting at the moment. Higher interest rates cause everyone's mortgage repayments to go up, possibly leading to a vicious circle where disposable income falls even more. It can even help to push the economy into recession. But it's important to realise this. The relationship between inflation, the interest rate and property prices is not that simple. Many today are on fixed rate mortgages of 1, 2 or even up to 5 years. So high interest rates have a delayed action effect on the market. Plus, interest rates are still pretty low. Bank rate is just 1.25%, and you can still get a 2-year fixed rate remortgage for about 2.5%. So this means higher interest rates may not have quite as much an impact as they did years ago. In 1990, for example, the interest rate on your mortgage would have been over 15%. I remember those days, a big ouch. So should you buy or invest in property when inflation is high? There's a lot to think about here, but the facts tend to show there's more to be gained by buying property when inflation is high than by not buying it. Let me give you a very simple example. Imagine that I decide to give you £200,000 in cash to buy a property with, but I leave it up to you to decide whether to buy it now or to sit tight and wait and see what happens. let's say you decide to sit things out and you put the £200,000 cash in the bank. And let's say that inflation is 10% over the next year and that property prices also rise by 10%. Actually, that's not too far away from where we are right now. This time next year, your £200,000 will be worth very roughly only what £180,000 is worth today, give or take a tiny bit of interest. And a £200,000 house will cost £220,000 to buy. So you're effectively losing money just by doing nothing. But look what happens if you use that money to buy a £200,000 house. Assuming again that inflation and property prices both rise by 10% over a year, your money has at least kept its value by being in property. And if property values rise more than inflation, you'll actually have made some money. Now that's what's happened over the last few years. To actually lose money by buying property now, you'd need property prices to fall, and fall well behind inflation. That's something that doesn't look very likely at the moment. And this is the important thing. Even then, it would only be a paper loss. If you simply sit on your property and wait for prices to rise again, you wouldn't actually lose any real money. Now, yes, you could argue that if you keep your £200,000 in the bank and property prices fall, you could jump in and buy a bargain then, but then inflation will still have eroded the value of your money. And one theory about inflation suggests that eventually wage rises catch up with inflation. So, sooner or later, people start buying houses again and house prices start racing ahead of inflation once more. So then, what if anything should you do? Now, I'm not saying this means that you should necessarily rush out now and buy that property without thinking it through. The example above is only a very simplified example using random figures. You need to keep an eye on what actually happens and what the experts are forecasting for property price changes and for inflation in the years ahead. Take expert advice where you need it. Then make your own decision on the best thing to do for you. But I think all this shows that property can be a very good hedge against inflation. Even in periods of high inflation, the odds that you will be better off by buying property are greater than the odds you will be better off by waiting. I hope you found this video useful. And if you have, then please hit that like button below so that others just like you will get to see it, and also subscribe to our channel so you get notified of other videos that we post each and every week. You'll also see on your screen right now some more videos that will help you within your property business. Thanks for listening.